All right, Zeta Global is a stock that I've had a lot of requests to cover both from channel members and subscribers. So I'm recording a video on this stock based on your recommendations. So please continue to deliver those recommendations in the comment section below. I am paying attention and I am going through these as I approach my list and I look at new companies to cover. Let's look at Zeta Global, which is an interesting marketing company based on artificial intelligence, and revenue is soaring, profits are expanding, but yet the stock price is declining. So I can understand why a lot of investors had questions about this company. What gives here? Revenue is growing, profit is growing, but the stock is falling, right? That's usually a curious position to find a company in. So I'm going to review the company's latest developments, the quarterly earnings results from November 11th, 2024. Look at the company's valuation by also looking at its forward prospects over the next few years in terms of cash flow from operations expectations, and then comparing it all against the valuation to determine if I think the stock is a buy on this dip here. So let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so Zeta Global delivering record revenue of $268 million in the latest quarter, which was up 42% year over year. Cash flow from operations of $32 million was up 51% year over year, and free cash flow of $26 million was up 93%. As a result of those excellent results, the company is raising its target again for 2024 to an increase of 40%. Now, one thing I'm already noticing right off the bat that could have disappointed investors is scale, is economies in scale here. You're seeing 42% revenue growth, but you're seeing cash flow from operations increase by only 51%. Typically, investors like to see a bigger margin there. When revenue grows by 40%, they want to see cash flow and profits growing by 80, 90, 100, 120% because they want to see your cost staying relatively flat while your revenue is increasing, creating that separation, which I'll talk a little bit more about a little later in this video. All right, so management saying that our momentum can be directly linked to the acceleration of the AI revolution, where marketing is at the forefront. That's creating an unprecedented opportunity for a disruptive technology like the Zeta marketing platform. The CFO chimes in and says, our performance is best summed up by the momentum that started in the first quarter, accelerated in the second quarter, and continued in the third quarter. 2024 has been a good year for Zeta Global. Looking ahead, the company is forecasting revenue growth of 40% at the midpoint for the next quarter, and it's increasing its profit guidance, adjusted EBITDA, to a midpoint of $65 million, which is up about 10% from their previous forecast. So the year is going so well that they increased their target again, but this would represent an increase of 47% at the midpoint. So you're growing revenue at 40% and you're growing adjusted EBITDA by just 47%. That shows that there's a lot of cost increases in the company, and it's not yet in a position to deliver those robust increases in profitability as revenue grows. They still need to invest in the business. They still need to spend more money. With each incremental revenue dollar that comes in, you have an extra percentage of revenue that's going up, a cost that's going up. So I mentioned I would talk a little bit more about the costs in this business, and here we are in the income statement where the company shows you their latest 3-month performance for the quarter that ended September 30th and the latest 9-month performance. So what you'll notice here, yes, revenue is growing very nicely on the top line, but what's troubling is the increases in the cost of revenues. So you have the cost of revenue rising by roughly 50% here, from $73.5 million to $106 million in the latest quarter year over year. Similar story when you look at the first 9 months of this year. The cost of revenue has jumped from 180, let's say 190 million, up to 274 million, right? So you have an 80, 83, 84 million increase in cost of revenue. Sure, revenue increased nicely at 180 million, but you had a 50% roughly increase in cost of revenue as well. So this is being picky here when you're dealing with a company that's growing as nicely as Zeta Global with profits also growing. You're getting picky here by saying, well, the cost of revenue is increasing by more than what you would like, right? It's not a perfect company. It's not generating the type of results like NVIDIA. NVIDIA is something like a perfect company, right? Investors have gotten spoiled by looking at NVIDIA as an AI stock because its revenue grows, its profits grows, its cash flow grows, its costs stay low, everything works well. That's a rare company with rare types of performance. The good news here for Zeta Global is general and admin expenses are staying flat or declining. In the latest quarter, they fell by, a couple of 100,000 here. And in the latest 9 months, they're down by 4 million year over year. These are my least liked expenses. General and admin expenses are money you pay for your corporate offices, for management, for the board of directors, for your annual Christmas party, for travel expenses, et cetera, right? These are things where I'd like to see companies keep costs flat or declining. I don't want to see you spending more money in these categories as your business grows. That doesn't mean you should have a nicer setup for your Christmas party. That doesn't mean you should upgrade to better headquarters in a more expensive part of town. I don't want to see those kinds of costs creeping into a business, right? So I like that for Zeta Global, those are staying flat. And overall, even though they're losing money on the bottom line, if you look at their operating loss, it improved meaningfully from negative 37 million down to negative 12 million. And similar story for the first 9 months of the year. So great improvement here for the company, although you can be picky and highlight that their cost of revenues go up by a large percentage every time their revenue goes up. So the business isn't built as well for economies in scale. The economies in scale are not that large yet for this company. Cash flow from operations was a bright spot, rising to 90 million, up from 63 million in the first 9 months of 2024. And that's because the company uses a significant sum of stock-based compensation, which is a non-cash expense, but it does add to the number of shares outstanding, which could be diluting shareholders, which could be another reason why investors were not too excited about the company's latest results. And you can see here the stock price, after starting off the year really strongly, rising up closer to $40 per share, fell after the recent results now down to $21 per share, which is probably why many of you were asking about this company, asking if it's a buy on this dip here. If we zoom out a little bit and look at the company's cash flow from operations to sales over the last couple of years, this does not look great, with strong improvement from 2022, and then starting in late 22 and early 23, you're not seeing very much improvement in the company's cash flow from operations to sales number. Again, failing to deliver on that expansion that you like to see when revenue is growing. You like to see margins expanding and cash flow expanding as well. So the stock is trading at a forward price to earnings of 27, which is right about the midpoint where this business has traded for in the last 3 years. It's been more expensive at times, trading at a forward PE of above 40, and it's been a lot cheaper at times, trading at a forward PE of 10. Looking at Wall Street expectations for the company's cash flow, you can see here the free cash flow line item here. And please tell me if this is too small for you when you're viewing it. I can make an adjustment to make it larger the next time I use this source. This is ticker, by the way, TIKR, where I'm getting this data. And the analysts on Wall Street that are forecasting for this company, they expect its free cash flow to rise by 29% in 2024, 31% in 2025, 27% in 2026, 21% in 2027, and 30% in 2028. So analysts on Wall Street that are following this stock expect roughly 26 to 28% growth in the company's free cash flow over the next several years, which is roughly in line with the company's forward PE valuation, forward PE of 27. So all things considered, I do think Zeta Global stock is a buy at current valuations. The current price represents a favorable long-term risk versus reward for Zeta Global. And thank you so much for requesting this video. Please, if there's any other videos you would like to see, comment in the section below. I will add them to my list and go through them over time. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.